Okay, we're going to go ahead and get started. Um, Quick public service announcement. One more time, I wasn't clear earlier. On the parking passes, you don't have to deal with the machines inside the building. You're just going to go right to the gate that goes up and down. And that's where you'll do the ticket in, ticket out, and scan your ticket. So people are asking me if they had to deal with the machines where you have to pay. The goal is for you not to pay, so avoid that at all costs. Um, uh, I'm going to introduce our next speaker, but before I do, I have a quick little um, right. Yeah, the white ticket you got when you first came in, you had to press and get a white ticket out. So when you leave, you'll go to the crossbar thing, insert the ticket. It'll say provide payment, and there's a scanner right there. You'll scan that white piece of paper that we gave you, and it'll say thank you. Proceed on out. The scanner. Yep. Then the little square piece of paper we gave you today. Is that all right? Is that good? Yep. No, for e-pass, you just like if you have an e parking permit, you just scan the parking permit. Yeah, if you have one of the employee parking passes, you don't have to worry about it. Good? Okay. Um, I'm going to introduce our next speaker. Drew Kopelka is a TIA Director for Institutional Investment Strategist. He has been with TIA for 5 years now. He has over 20 years of experience in the industry, and I thought I should do something before I introduced him. And so when I found out several weeks ago that I was going to be introducing him, I thought I should go to do what we all do when we find out somebody new we want to find out something about. We should Google them. So I thought to myself, you know what I've never done? I've never Googled myself. And you know what Google said? Who? So without further ado, I would like to introduce Drew to you all, and I think you're going to really enjoy his speech and have a great time with it. Thank you all very much.
Thanks, Ward. Yeah, appreciate it. Thank you. Thank you. Wow, what a crowd. Good to be here, everyone. Thank you for having me. I'm glad I wore my blue tie today, so hopefully won't kick me out too fast. I'm with TIA, as Ward said, and part of TIA's mission and a big part of my job is helping folks like you make the right decisions to allow you to retire with peace of mind, with security, and with dignity, to allow you to have a plan that you're comfortable with, that allows you to foster that secure retirement. So that's what we're all about. TIA is a mission-driven organization, and obviously a big part of that are the activities that you're taking on your own, right? How much you're saving, all those kinds of things. And Ward was telling me about the very generous employer contribution here. So you're already off to a great start relative to a lot of others who are trying to save for retirement. But we also know that an important part of that are the investment decisions that you're making, right? You're all responsible for making your own decisions around how you allocate that employer contribution and the contributions that you're making. So today, my goal is really to help put some of this in perspective, to, if not help you make better decisions, at the very least, maybe help you not make the wrong decisions. To add some perspective so that when you're at home and you see the headline on the television, or you read something in the newspaper that sounds really bad, that you have a better perspective in which to kind of absorb that and to think about how that fits into your retirement plan. So today we're going to talk about how informed investors ride out market volatility. And market volatility is really just a term for how much the markets are going up or down on any given day or over a period of time. Think about a roller coaster ride, right? How high are those bumps, right? Those ups and downs. And market volatility, or volatility as a term, it doesn't have to be a bad thing. It doesn't mean that it's going down, right? Volatility can also be going up, but it's those swings, right? How much is it going up and down? But for all intents and purposes, market volatility tends to be associated with, in a negative way, right? It tends to be associated with markets going down, with losing money, right? So today we're going to talk about market volatility, and we're going to break it out into a few different sections. We're going to talk about some of the potential sources of market volatility, kind of generally, kind of bigger picture, what kinds of things are going to drive the market from that perspective. And then we're going to really dive into kind of what we see going on in the market today. What are some of those current drivers that are moving the needle today? I think you can probably guess what some of those are. And then importantly, we're gonna look kind of the third pillar at investors' behavior, right? We're gonna talk about kind of the average investor and what we see in terms of people making the wrong decisions at the wrong time, and hopefully that'll give you some insight as well. There are two handouts. I know my colleagues at TIA distributed two pieces that you should all have in front of you. So one of the pieces is about that longer-term stay and invested view. We'll talk about that at the end of my presentation, but this is part of that emotional piece that I was just referring to. And then we also included our fourth quarter outlook. These are the best views. This is kind of the latest and greatest from our Global Investment Committee in terms of where we see the economy right now and where we see things going. And you can see, even on the header, a little bit of a spoiler alert, expect a tougher climb. We've been saying this pretty much all year, a tougher climb, a rockier climb, edgier climb. So the theme is still kind of a tougher climb, but the good news is it's still a climb, and we still are not expecting or anticipating a recession in the next 12 months. We still think that's very unlikely. So a little spoiler alert, we still are pretty optimistic about where we are in the cycle. So let's dive into it. Let's dive into some of the potential sources of market volatility. So kind of break this out into four pillars. The first is geopolitical, the second is economic, the third are around bubbles, and the fourth is around structural or technical factors. So geopolitical probably makes sense. I mean, we're talking about issues in the Middle East. Historically, oil was a little bit of a bigger deal than it is today, so issues in the Middle East tended to really drive markets in the sense that it would impact oil prices, terrorism, wars. Obviously today we can think about issues in Ukraine, we can think about North Korea. Obviously the big elephant in the room is trade. So that's what everyone's talking about today, the issues with China and trade. So that's really what we're going to talk about in a little bit on the geopolitical front. On the economic front, this is more domestic, right? What is the Fed doing? What's happening with interest rates, employment, things of this nature? So we're going to dive into that quite a bit because there's a lot of things happening there. We're probably going to talk less about the other two, asset bubbles. That would be, think about the dot-com bubble burst in the late 90s, right? The technology bubble. That certainly created a lot of volatility and led to, or partly led to a lost decade in stocks over the 2000s. You could even think about the Great Recession in 2008, 2009, and the housing bubble, so to speak, that really led or contributed in a big part to that. And then lastly, on structural factors, a recognition that not everyone is investing their money with a long-term view to save for retirement, right? There's hedge funds that are short-selling stocks. There's trading firms that are looking to make some money on little spreads on a daily basis, and there's a lot of computerized, algorithmic trading going on that also can drive the market. Those tend to be, to the extent that that drives volatility, that tends to be much shorter in duration. But those things nonetheless can impact the markets, and sometimes the things that you hear in the news that we don't think are really driven by the fundamentals as much. So that's kind of how we lay out these potential sources of market volatility. And what we're going to do now is move more into kind of where we are today and the current drivers within each of those four buckets. But before we do, I mentioned that we are pretty constructive on the economy. Not to say that everything's rosy, but we still don't think that we're headed into a recession tomorrow. And to put some of this in perspective and to help you feel a little bit good here as we start out, the good news is that the U.S. economy, the global economy, is growing more often than it's not. This chart looks at U.S. GDP growth, right? Gross domestic product. And this is looking at the year-over-year change. Is the economy growing or is it not? And obviously I talked about the Great Recession in 2008, 2009. You can see that big dip. The markets from peak to trough fell over 50% over that period. Clearly the markets and the economy is really driven on how well we're growing, right? If the economy's growing, that tends to be good for earnings, that tends to be good for the stock market. And this chart gives you that longer term perspective, looking at this 70-year period that shows you the economy is growing more often than it's not, and that's a good thing for being a stock investor with a long-term view. So I mentioned volatility is just kind of the ups and downs in the market. How smooth is that ride, or how rocky is that ride? The green chart, or the green line here is the VIX index. So that's a measure of volatility. We call it the VIX. It's kind of an index that shows how high or low volatility is. So the point I want to make here, this goes back, looking back over the last 30 years or so, and this kind of puts in perspective that, there's, we've seen some volatility. We saw some in the summer. We saw some at the end of last year. But historically speaking, the markets are not terribly volatile right now. And again, you look back at the Great Recession in 2008, 2009, you saw kind of where things were. So a little bit of a longer term look at volatility. If you look at the black line, that's the S&P 500 index. That's one of the more one of the indexes we use most typically when we look at the U.S. stock market. And you can see again how in periods where volatility is extremely high, it tends to be associated with declines in that index. So again, if you look at that 2008, 2009 period, you can see the spike in volatility, and you can see how that was associated with a pretty strong decline in the S&P 500. And you look back over other periods as well. So the point here is that when volatility is extreme, it does tend to be associated with pretty ugly periods in the stock market. But volatility is something that we live with and is part of the equation. So again, we talked about the economy growing most of the time. We talked about if the economy is growing, it tends to be good for earnings. It tends to be good for stocks. This is just a look at earnings alongside the S&P 500 as well. So the blue line is the S&P 500 earnings per share, EPS. That basically is how much is a company earning per each share. And you can see the very close correlation. So this chart is just to make the point that when earnings are good, that tends to be associated with good times to be an investor. And it's very closely related to the stock market, again, over long periods of time. Just a quick comment in terms of where we are today. And we'll talk a little bit more about this at the end, kind of as I kind of make the case and share some themes in the outlook that you have. Global growth is slowing, right? There's parts of Europe and other parts of the world that are in recession today. Manufacturing globally, certainly here in the U.S., is in a slowdown. So we're worried about some of these things, but there's enough good news that's kind of offsetting the bad news, and we're kind of in this hum-hum kind of environment. That's kind of some of the themes here on the right. There's things are not that bad, but there's some things that we're worried about, and it's particularly themes around growth and trade. On the left-hand side, just kind of making the point that, or trying to set the stage for kind of expectations going forward, because we are in the longest bull market run in history. And the blue line shows the year-to-date performance of these different asset classes. So this year-to-date, where are U.S. stocks, and this is broken out into different categories, non-U.S. bonds. EM stands for emerging markets. And what's great is this is a great time. I was on a plane last night coming in from New York, and there was a headline on the TV screen that said 2019 has been one of the best years for investors. It was something very nondescript like that. And it's true. It's very rare that you see every asset class globally in this positive territory. So if you look at the blue lines, every asset class is up this year. Now, just to add a little context, we had a 20% correction at the end of last year. So part of this was kind of the rally in the beginning part of the year that made up for kind of where we were. But nonetheless, this year has been a really good year. But the black line, or the darker bars, show the performance of these asset classes for the second part of this year to date. So from June 30th to today. And you can see it's a little bit of a more muted picture. Things are starting to kind of slow down a little bit in terms of returns. And we do think that investors should anticipate maybe returns more in those single digits and not the 20% that we're seeing in the S&P 500 year to date. So just kind of setting the stage. We're going to come back to some of these themes as we move on. So let's go into the current drivers. I mentioned issues around trade is really what's driving this, right? Terrorist attacks, Brexit. Brexit is very much a part of this too, but I really don't have too much to say about it because Brexit's been something that we've been in this it's been 3 years now where this has been in the news. We were supposed to get a deal last Saturday. That didn't work out. It's anyone's guess kind of where this all lands. We still think that there's enough mutual interest in a deal happening, so we don't see this being a catastrophic event. But clearly, what happens with Brexit is going to impact the markets and could lead to some volatility. Terrorist attacks, just to put some of this in perspective in terms of when we talk about volatility and things that can impact the market. I almost hate to use this example, but I think it's telling when we think about 9/11. That was an unprecedented period of time obviously in our history, and for the markets where the stock market was shut down, right? Basically, the markets just paused. They were closed for a week. That's never happened before. And the first day that the markets opened, the S&P was down 8%, ended down over 12% that week. Airline stocks, travel and tourism stocks, bank stocks were down in major double digits. It was only 1 month, though, after 9/11 until the markets regained what they lost. So even an event like 9/11, 1 month later, we were back to those pre-9/11 levels. So it's a testament to how resilient and strong our economy can be, even in these type of events. But for all intents and purposes today, it's about trade on the geopolitical front. It's what's going on with the U.S. and China. Excuse me. So this first slide, I don't have too much to say here, but this first slide makes the point that we have less to lose when it comes to trade issues than other parts of the world. The blue line shows how much trade represents as a percent of our economy. So it's looking at imports and exports divided by gross domestic product. And you can see we tend to consume a lot of the same things that we produce here in the US, certainly compared to Europe, which is the darker line, that's much more reliant on trade. And China is probably somewhere in the middle. We can't trust the data, so we don't know exactly what it is, but it's probably somewhere in the middle here. So we have less to lose than other parts of the world when it comes to the trade issues that's just adding a lot of noise right now. It's kind of interesting that the Eurozone is kind of an innocent bystander in all this, right? They're not involved in this, but they're actually being hurt the most at the end of the day. And I mentioned that there's countries in Europe, Germany in particular, that are in a recession right now. And these trade issues and what's going on with us and China is certainly not helping. But the point here is, up to now, this has not impacted our economy in meaningful ways yet. But it's not to say that there aren't pockets and there are not areas of the market that are being impacted in significant ways. Soybeans are the U.S.'s largest export crop, and China is the largest buyer of soybeans. So soybeans were among the first that got hit with tariffs about 2 years ago, or a little less. And you can see how it just fell off a cliff, right? China just stopped buying our soybeans. So obviously that really impacted farmers here in the U.S. You hear about that a lot, how it's impacted farming, and soybeans is one of the examples here. You can see how things have thawed out a little bit recently, and it's kind of ticked back up a little bit. But this is an example of how specific industries, specific areas in the market can be meaningfully affected by some of what's happening. But in terms of the broader picture, in terms of how it's impacting our GDP and the economy on the whole, we haven't really felt it yet. There's actually been some excitement in the last few weeks because we had a little bit of a kind of a deal a few weeks ago where we basically agreed to kind of time out and not impose additional tariffs on China. They agreed to increase some of their agricultural spending and adhere to some mild concessions on some intellectual property concerns. But we still have some tariffs that are set to take effect again in December. So we think this is going to continue, and we honestly don't see anything here that's going to really change in a meaningful way until after the 2020 election. So it's probably stating the obvious, but this is going to continue to be noise. And up to this point, it hasn't impacted consumers and our economy too much, but something that we're obviously paying a lot of attention to. It's also important, though, to realize it's not just the issues with U.S. and China on trade that are driving some of these trends lower. We are in a slowdown in global growth. So when you look at exports and you look at this, it's not just because of what's happening with trade. It's in large part because the U.S. economy is coming off of this period where we've had, again, the longest bull market in history. China's already been slowing down a little bit. So from a bigger picture perspective, when the economy is slowing, when growth is slowing, that tends to slow trade growth as well. So this is just looking at our export growth and China's export growth, putting it in perspective over the last 10 years or so. and showing that clearly this is slowing, but it's not just because of all the sparring that's happening on trade. There's other things that are impacting this. So just important to kind of keep that in mind. So that's the geopolitical stuff. We'll move on now to the economic side of things. So this, we could probably spend all day talking about some of these things. I mentioned it's interest rates, it's inflation, it's public policy and uncertainty around that. It's around employment. So we're going to talk a little bit about interest rates and inflation, and we're going to kind of weave in a lot of some of the comments I made about where we are in the economy, where we think we are in this section, because it all fits together pretty well. So interest rates, very exciting part of the presentation, but I hope you'll understand why we're going to talk about this a little bit. So when you hear about the Fed cutting rates or raising rates, we're talking about the Fed funds rate. Okay, this is a short-term interest rate that banks use when they lend to one another. And ever since the Great Recession, you know, basically rates came down. The Fed basically went almost to zero to accommodate the economy that needed it at the time. And then we've been in this period since then of very, very low interest rates, basically zero. You can see all the way up until the end of 2015, when the economy was seen healthy enough that the Fed was able to start raising rates. And then we went through this cycle for the last few years where the Fed has been raising rates 25 basis points at a time, kind of trickling up. And guess what happened starting this year? They started cutting rates now, right? So you can see that in this chart. So the Fed funds rate right now is at about 2%. It's in this 2 to 2.25% kind of range. But what you see that's interesting here is the Fed is basically telling the market that they think that this is about the right place, right? They need to see more economic data that really is going to change their opinion before they're going to indicate whether they might continue to lower rates or not. But the market, which is the green dots, the market's predicting that the Fed's going to keep cutting rates. So when we talk about volatility and things that you might hear on the news, this is a great example where, you know, part of this is just, you know, the Fed doing something that the market, you know, is thinking they're not going to do, or vice versa, right? And then that causes disruption, right? The markets hate uncertainty. So the point here is the markets are expecting that rates are going to drop, and the Fed is not necessarily saying that they're going to be doing that. This is another way of looking at it. The green bar is the Fed funds rate over the last 2 years or so, and this is looking at the futures market. So this is looking at where the market is anticipating the Fed funds rate will be in January of 2020 and January of 2021. So the blue line is basically saying that the markets are expecting the Fed to cut rates again by January. There's 2 more meetings. There's one before the end of this month and another one in December. So the market's thinking that the Fed is going to cut at least one more time here, and then by January of 21, they think rates are going to be even lower. This is just another way to look at it. This is the market implied probability of a Fed rate cut. So what you can see, it's kind of interesting. This is just year to date, going back to January. So if you see the top, the green, it's hard to see. You know, the market was basically thinking as we came into the year and as we got more into the year that the Fed was going to cut rates. So by the time we got to July, when they actually cut rates, it was almost a near certainty that you know, the market was thinking they're definitely going to cut rates, and they did. And then you can see the darker line, right? Again, the market, okay, they're probably going to cut rates again. Very high probability, they did. So two rate hikes this year. Okay, so now you see those top lines kind of reset. So the green and the blue are the probability that they're going to cut rates 1 or 2 more times this year. So you can see the market's still thinking they're going to cut at least 1 more time, probably a much lesser chance they're going to do that 2 times this year. Not to go on and on, but this is the stuff that causes market volatility, right? So enough on the Fed funds rate. Let's talk about another important interest rate. This is probably the interest rate that matters more. This is the 10-year Treasury. This market is not driven by the Fed. So this is, excuse me, this is based on market forces. This is based on supply and demand. The reason that the 10-year Treasury is important is that this factors more into things that matter to you. This is the interest rate that tends to be correlated with, you know, the interest rate that's tied to your credit cards, to your home loan. This is also the rate that's going to impact, you know, your savings account, things of that nature. So when rates are low, that's a good thing when you're borrowing money, but it's not a good thing if you're trying to save money in a savings account or you're buying a CD. So this is the 10-year Treasury, and you can see how how this has come down in a meaningful way. It was over 6%, just 20 years ago. So this has continued to come down. The Great Recession was really part of what brought this down. It was partly because of the Fed funds rate, but it was also because the Fed was expanding their balance sheet, printing money, and that was continuing to keep interest rates very low. They hit a low of 1.37% in December of 2016, and then they went up. Earlier this year, it was up as high as 3%, and then over the summer, it came back down, almost back to that 1.4, and today we're at 1.8%. So this is certainly something that can also drive volatility. This is directly correlated to the bond market, and we think this is a reflection of how investors globally feel about the U.S. economy. So I won't go on and on, but this is also a very important interest rate. When we talk about interest rates, we're talking about the Fed funds, and we're talking about that 10-year Treasury for the most part. So moving on to inflation. This is also something that can cause market volatility. It was a year ago, I think, in February or March, where we started to see some signs of wage growth, and it spooked the market. Folks were worried that this was going to cause inflation to rise, and the market responded to that in a meaningful way. The point of this slide is, by historical standards, inflation is still very, very low. This is not something, the Fed keeps a close eye on this, but it's certainly within their policy range. It has been for some time, and we don't see this as being something that is part of the talk today. If you think about the Fed's mandate, it's a dual policy mandate, right? It's about full employment and price stability. So the Fed, when they're making decisions around interest rates, they're focused on making sure that we have full employment and that inflation is in check. And I think by both of those measures, things are looking pretty good right now. So anyway, inflation is not one of the issues today, but it certainly could be, and it's something that a lot of folks are looking at. And it doesn't have to be inflation; it could also be deflation or stagflation, right? That can also be catastrophic for the economies. So I mentioned uncertainty and how markets hate uncertainty more than anything else. So this slide is kind of making the point that over the last 20 years, global policy uncertainty has been rising, and today it's at the highest levels it's been in a long time. So again, goes back to Brexit, goes back to trade issues, goes back to things that are happening in Washington here. This is a global look at policy uncertainty. This is what politicians are doing. This is monetary policy, fiscal policy, things of that nature. The point here is that global policy uncertainty is at the highest level it's been in a long time, and this is important because it can impact businesses' decisions to hire, right? Investing in their companies, investing in their employees. If they're uncertain about where the markets are going, where the economy is going, they might be less willing to make those decisions that are going to be helpful. And guess what the number one source is here in the U.S.? So this is moving away from the global side and looking at the U.S. Guess what the number one source of uncertainty is? It's all about trade. And what I like to point out on this chart is, if you go back and you look back over the last 10 years, it wasn't until, obviously, just recently that trade started to become something that we were talking about. So there were other times when national security, monetary policy, regulations, right, Dodd-Frank and things coming out of the Great Recession, that was something that was a big deal back at that time. But obviously, trade trumps everything now, by far the overriding source of policy uncertainty. So I mentioned that we're pretty constructive on the market. We don't see a recession coming here in the next 12 months. We think the probability of that is still under 30%. This is one reason why we've still been constructive. This is looking at leading indicators. These are data points that help us look into the future a little bit. So it's hiring plans, it's new investment or expansions that companies are making, their orders, sales, housing permits. So the market is part of it, right? So this is a basket of data points that we think tell us or give us an indication of how companies and consumers are thinking about the future. And what's interesting here is the dark gray lines are periods of recession. And you can see, I mentioned we're in the longest bull market that we've been in history, and you can see from 2009, we've just been in this kind of steady rise. you can see there are periods where these leading indicators started to taper off a little bit, but then they kept going up, taper off, go up. Nowhere in the expansion have we seen these indicators dip down. And in every other period where there's been a recession, we've seen that the indicators actually come down for at least 3 or 4 months before then we would go into a recession. So the point is we need to see this line start to go down before we're really concerned that a recession is right around the corner. So I think that's just helpful perspective. Well, like anything, you can take numbers, you can take data, and you can tell different stories. This tells a very different story. This looks like a very alarming story. You can see the header. So why is everyone so worried about a recession? This is a chart. This is the New York Fed's recession indicator, and this is the New York Fed's way of predicting a recession 1 year out. So this is the odds of a recession 1 year from today. And if you just look at the green mountain chart here, which is that chance, and again, you look at the gray bars of past recessions, this certainly would look pretty alarming, right? That a recession certainly seems to be looming. There's a lot here. Well, guess what? There's only one data point that goes into this chart, and it's the yield curve. Without getting too technical, some of you might know what I'm talking about, but it's the slope of the yield curve. It's the difference between short-term rates and long-term rates. And in a healthy economy, longer-term rates are going to be higher than short-term rates. Think about it. If you're going to loan money to the US government for 10 years, you're going to want a higher return than if you're loaning the government money for 3 months or for a year. And what this chart, what the green chart is showing, is when that yield curve inverts, when longer-term rates actually dip lower than shorter-term rates. And by far, this has been the single best predictor of a recession in the history of the US economy, where when we see that yield curve invert and it sticks there for a few quarters, very, very likely that within a year we're going to be in a recession. So this is telling you a different story from the slide that I was just showing you. What's interesting is that just last week the yield curve uninverted because the market was relieved with the thought that we might be closer to a deal on Brexit and that things with trade issues with China might be thawing out. So we still haven't seen the yield curve stay inverted for a period of time. Again, that would lead us to kind of being more concerned about this chart. But there's one other thing, and it's very I need to be careful, right? Because it's very hard for me to. I worry about using the phrase "this time it might be different," but we do think that this time might be a little bit different when we're talking about the slope of the yield curve predicting a recession. And the reason that this time might be a little different is we are in an unprecedented period of time where global interest rates are very, very low and in some places negative. This shows you the percent of investment-grade bonds globally that are actually trading with negative interest rates. So you're seeing almost 25% of the market for investment-grade bonds globally are actually paying negative rates. Think about that. In Germany, if you were to lend money to the German government, you're going to pay them for the privilege of loaning them money. It's kind of just hard to get your arms around, but it's a function of the interest rate environment globally. And we think that part of this is adding demand for US Treasuries. If you're a German investor, why would you do that when you could loan money to the US government and you could at least get almost 2%? So we think that, we think that that's a big phenomenon that's driving these low rates and the yield curve inversion. So happy to take some questions or talk more about that, but we think that this is a little bit different, and that's why we're not quite as concerned with this chart as maybe we would be if we weren't in this type of an interest rate environment. All right, so enough of that and scary news. But I did mention that we are in this kind of global slowdown. That global growth has been slowing, and this chart also just adds some color there. So this is the Global Purchasing Managers Index, or the global PMI. It's broken out in this chart by manufacturing and by services. So you can see, I mentioned we are in a slowdown when it comes to manufacturing globally, and certainly here in the U.S. Anything on this chart that's below 50 signals a contraction. Anything over 50 is signaling an expansion. So manufacturing is definitely in a contraction mode, but services and other parts of the economy are not. They're still growing, and albeit not at the same pace as they were, but still growing. So again, it's this theme of enough good news is offsetting some of the bad news. We're kind of in this ho-hum. kind of keep chucking along. Nothing here yet that's kind of alarm bells. And one of the things that is adding some optimism is that the U.S. consumer is really the shining star along the way here. So we think U.S. GDP is really driven in large part by the U.S. consumer. And consumers are still confident. They're still spending money. There's still signs of wage growth. And obviously we know unemployment are at all-time lows. So this is just looking at the University of Michigan consumer confidence and the Conference Board. And this is just showing you that the consumers are still continue to be constructive on the economy. They're talking the talk, and they're also walking the walk. This is looking at U.S. retail sales growth. You can see the dip earlier this year. That was partly because of the government shutdown and how that impacted folks' paychecks for a period of time. But you can see how it came right back, and folks are still out there spending money. And oh, by the way, folks are saving more too. So this is looking at the personal savings rate and also looking at average hourly earnings growth. So you can see that wage growth I was talking about. It's certainly picking up a little bit, and people are saving more as well. So if you look back in the 2008-2009 period here, you can see folks were not saving at the same rate as they are today. So that's another thing that gets us a little more comfortable that even if we do move into recession, on average, consumers might be in a better spot to withstand that today, certainly than they were 10 years ago. I talked about unemployment, all-time lows. This green bar is the unemployment rate, and it ties to the left axis. You can see that below 4%, lowest unemployment in 50 years. I guess to end on a mixed note, this also looks at the unemployment rate against the federal deficit or surplus. So how much is the government spending money or not? And one of the things that we do think is a little bit interesting when we look at this over the last 70 years is it's very rare in a period of such low unemployment that the government is continuing to kind of be in a deficit mode. And this is really a reflection in large part of the tax cuts. So the tax cuts added a deficit for the government, and it's very rare that they do that at a time when unemployment is so low and the economy is relatively healthy. So we do think perhaps there might be something in here that needs to kind of come together, and maybe this is something that adds some fuel to what the next recession might look like. I'm not sure. It's just something that we think is kind of interesting and a little bit unprecedented. So again, hope you're getting the picture. It's a balance. There's good news and bad news, but again, nothing that's really worrying us too much as it relates to the economy. But we do know that a recession is inevitable. That's the way market cycles work. But it doesn't need to be terrible either. And we're going to talk about that on the sheet in a minute. So just to close out, let me see how we're doing on time. Okay. To finish on the structural and the asset bubbles. Not going to go into too much detail here because there's really nothing in these categories that we think is driving market volatility today. It's really about valuations when we talk about bubbles. So I'm going to talk a little bit about valuations in the stock market. We don't see anything else here in terms of real bubbles or real structural factors that are really causing a concern. But if you look at, sorry, this slide. I talked about valuations, and valuations are really another way of thinking about this. Talking about earnings. Are companies earning money? Are they growing? And then that tends to be associated with good stock market performance. And we do think that earnings growth is going to be slowing down a little bit this year. The earnings have been pretty good this year, but ever since the tax cuts, when we had a great earnings year last year, right, that really helped catapult corporate earnings, right, because the tax cuts came down in a meaningful way. That kind of push has slowly been fading a little bit, and earnings have come down a little bit. So third quarter earnings just started to come out a few weeks ago. That's trickling in now. Most of that news is pretty good, but there have been some disappointments. And I think it was yesterday when we saw Jeff Bezos' net worth decreased by $7 billion because they missed guidance. So Amazon had a tough quarter. So we do think that we're going to get more of that kind of news. We do think that earnings are going to continue to disappoint, and we do think that that's going to translate into the stock market. I guess just again, when we think about valuations, the good news is stocks still look attractive relative to bonds. So if you think about this, this is really looking at what we call the my goodness, the equity risk premium. So it's looking at how attractive are stocks versus bonds when you think about the additional risk you're taking to invest in a stock versus what you could get in a more safe asset that's paying you an interest rate. So you can see it wasn't that long ago when bonds were actually looking, where stocks were looking less attractive, a little bit expensive compared to bonds, and you can see that that's come back up a little bit. So stocks are still kind of behaving the way we would hope they would, but they look a little bit less attractive in their own right. And this is just looking at valuations. This is looking at PE ratios, so price to earnings ratios on the S&P 500, so on that basket of stocks. And where we are today is in this 25 to 30 times earnings kind of bucket. Why is this important? What is this chart trying to tell us? This is taking a look at historically how the stock market performs kind of on a 10-year forward-looking basis based on earnings today. So what this is saying is in this bucket of 25 to 30 times earnings, we would expect equity markets to return somewhere in the range of 6% over the next 10 years on average. It's very simple. The cheaper earnings, the cheaper that the PE ratios are, the more constructive we would be on equity performance over that period, over the next 10-year period of time. And conversely, the more expensive stocks are today, we would be less constructive on that performance over the next 10 years. And the dot-com bubble burst is probably a good example, right? Stocks were very, very richly valued, and we ended up having a lost decade. We basically, if you were an investor in the U.S. stocks for the entire decade of the 2000s, you didn't make any money. It was basically a flat 10-year period. So we do think that investors need to think more about these kind of mid-single-digit kind of equity returns over the next 10 years based on where we are in the cycle today. So moving on to and closing out on kind of the emotional aspect of this and the investor behavior piece of this, I realize that not all of you are actively involved in making these decisions. It's really up to you and how much you want to be involved or not. The important thing is that if you don't want to get in this on your own, that you work with someone you trust, that you have an advisor, whether that's someone that you know that you trust or TIA also can help. We see most people make emotional decisions that are not good, that are not in their long-term best interest. So what I want to do is just highlight some things to think about. So this chart looks at, in any given calendar year, at any point in time in that calendar year, where the market ended for the year and where it was at any point in time during that year. So just looking, I can't see, but just looking at the most recent period, you see the 20% return. I think that must have been last year, unless it's year to date. And you can see that we ended the year up 20%, but there was a period of time in that year where the market actually was down, whatever that was, 2%. This is making the point that there's lots of times throughout the year, this is just looking at a calendar year basis, there's lots of times in that calendar year where things might not be looking too good, and then you can see kind of then, though, at the end of the year, how things perform. This is basically saying, you're not losing money unless you sell, and if you sell at the wrong time, you might be missing out in a big way. There's a few different ways to look at this. This is also looking at the risk of missing the best days in the market. I'm actually going to save this because it's in the handout, and I think it does a better job to show it. But this is actually really interesting too. This is looking at a Dalbar study. This is looking at the average investor. So this is looking at retirement plans broadly, right? It's looking across the industry, across record keepers, and it's looking at the average investor experience, which is the far right bar, and it's comparing it to other core asset classes on a 30-year basis. This is basically saying that the average investor is not even keeping pace with inflation, right? Based on the active buying and selling decisions that average investor is making. They're selling at the worst times, they're buying at the worst times because of this emotional aspect that when things don't feel good, you kind of react to it as opposed to kind of thinking longer term about market cycles. So I think this is really important to think about, that the emotional aspect of this is sometimes is not your friend. So I'd like to direct you to the Staying Invested handout that you should all have. It might be inside the Outlook. And I just want to walk through this real fast, and then we'll open it up for some questions. So again, I talked about the economy is growing most of the time. the first part of this makes the point that equity markets are positive and returning good, producing good returns more often than it's in a negative period. So you can see on the right, since 1937, stocks have been positive, producing positive returns 76% of the time, and on average, those returns were about 20% in those years. Conversely, their markets were negative about 24% of the time, and the average return in those negative years was about a negative 12%. So this makes the point that, again, even the best investors can't time the market, right? And this is saying that if you're a long-term investor, have confidence that the market's going to go up more than it's going to be going down. And then I mentioned time horizon. So the next part here also looks at rolling periods of time. Rolling 3 years, rolling 5 years, rolling 10 years. So it's saying, as of today, what was my experience as a stock investor for the last 3 years? In next month, what was the last 3 years? So that's how this is working. And the point that this makes is that the longer time you're invested in the market, the longer that you're fully invested, the less chance that you're going to actually experience those negative returns. The following page, if you flip it over, it does talk about market declines. Most drawdowns have been pretty modest. If you look on the right, it shows the number of times since 1937 that the market's been down between 5 and 10%, between 10 and 20%. Most of the drawdowns have been pretty modest, and you can see how quickly the markets have bounced back, typically within just a few months. So there's very few periods, right, where things have been more dramatic, but obviously the deeper the decline of the recession, the longer it does take to come back. So in the most recent Great Recession, it did take about 6 years for people to make their money back if you stayed fully invested. The point is, if you stayed fully invested, you did get back there, as opposed to people that pulled out and missed that comeback. And then the last thing here is in the miss. So this looks at missing some of the best days in the market, and that's the slide I went through fast. But this is important because we talk about volatility, and it does tend, when things get interesting, it does tend to be choppy. So sometimes the best days in the market follow the worst day in the market. So this talks about if you get out on the wrong day, how much that could impact your long-term portfolio. So when things are bad, sometimes the next day is good, and those swings can be wild, and they can be very, very impactful. So I think I've probably gone a little bit over time. So I better stop and just see if there's time quickly for any questions. I'd be happy to take them. I'll also be hanging out with my TI colleagues in the back for the rest of the afternoon. So happy to chat with any of you who have questions. The most important thing is to have a plan, to have a time horizon and a plan, and stick with it, to try to mitigate the emotional components that come into play. That's the most important thing. And if you know you need money within a 5-year period of time, maybe your plan is going to be a little bit different from someone who maybe knows that they don't need to touch that money for 10 years. I hope that some of what we shared was resonated and helpful. And again, happy to take any questions if there's time. I know we have a microphone over here. If anyone wants to raise their hand. If not, we can talk in the back of the room if you do have questions afterwards. Oh, right over here.
Yeah, so you had mentioned that you're looking at no recession for the next 12 months being stable. What are you seeing in the next 3 to 5 years?
That's much harder to try to predict. I think in the next 3 to 5, I hope I'm not being recorded. In the next 3 to 5 years, I think it's safe to say we will have had a recession. It's inevitable. It's the way the cycles work. The question is what does that look like? How hard is that landing? Is it going to be one of those 20 to 30% drawdowns, or is it going to be one of those 5 to 10% drawdowns? Because we don't see any bubbles, because we don't see anything on the horizon that we think could be catastrophic. I mean, I'm thinking the next recession is going to be relatively mild. We might be out of the recession before we even realize that we were in one. Again, so much is driven by the U.S. consumer, and there's a lot of things about our economy that are fundamentally still very strong. And we talked about Europe and other parts of the world that aren't as good. We're starting to see some encouraging signs coming out of Europe that they might be kind of starting to turn a corner. And as you think about the next 10 years, maybe non-U.S. returns are going to be better than U.S. returns. So it's also about having that broader view as an investor, regardless of what might be happening here in the U.S. Although we know, as the largest economy, that what happens here matters. I hope that helps a little. All right, well, I don't want to take up time from the next speaker, so please don't be shy. I'll be hanging out. It was a privilege to be here today, and I hope that some of what I said adds some value.